You drop your phone and the screen shatters. It's a common inconvenience, which is why many of us pay for extended warranties at checkout. However, that same person might leave their entire net worth exposed to a liability lawsuit or a medical emergency. This behavior stems from the analysis placebo effect. By qualitatively labeling our personal risks as low or medium, we feel a sense of security that doesn't exist in reality. Qualitative risk analysis relies on subjective feelings. Because individual interpretations of high or low risk vary, this method fails to account for actual financial exposure or mathematical probability. Organizations manage this uncertainty through quantitative risk analysis. Instead of relying on gut feelings, they assign specific numerical values to potential losses and use statistical models to guide their decisions. These cuneiform inscriptions on the Code of Hammurabi document some of the earliest maritime risk laws. Quantitative risk transfer has served as a standard component of commerce for thousands of years. Human intuition is not built for statistical accuracy. To protect your assets, you have to identify the specific events capable of causing a total financial collapse. Insurance facilitates this protection through a simple exchange. An individual pays a fixed, relatively small premium to an institution, and in return, the insurer assumes the cost of a catastrophic loss. This works because of the law of large numbers. By pooling data from thousands of policyholders, insurers can predict loss frequency with high accuracy, ensuring they have the reserves to pay out claims when an individual experiences a disaster. This matrix categorizes threats by plotting loss severity against event probability. Risks in the bottom right happen often but cost little. Retain these out of your cash flow as insurance exceeds the protection's value. The top left contains rare, devastating events. Transfer these to prevent insolvency. Focusing strictly on this transfer quadrant reveals that there are only 5 specific risks an individual must pay an institution to absorb. The first mandatory transfer is health insurance. As indicated by this ledger from 1912, medical risk pooling is a long-standing defense against the high costs of sudden injury or illness. Disability insurance is the second pillar. It protects your future earning potential, the primary engine of your wealth, if you become unable to work for an extended period. Third is auto insurance. This policy is necessary to transfer the potentially unlimited liability risk associated with bodily injury or property damage caused to others while driving. Fourth, homeowners or renters insurance protects your primary physical assets from definite accidental losses that would be too expensive to replace on your own. Life insurance is the final transfer. It is a contingent contract designed to replace the economic value of a primary earner for their dependents in the event of death. These 5 policies function as the mathematical walls defending your personal finances from a total operational collapse. These transfers are governed by the legal principle of indemnification. This ensures that insurance exists to make you whole again, rather than providing a windfall or profit. Indemnification is a post-event mechanism. Its goal is to return you to the same financial position you occupied immediately before the covered loss occurred. While the policyholder gets protection, the insurer gets to invest the collected premiums before they are paid out as claims. This pool of money is called float, and it is how investors like Warren Buffett generate significant capital returns. For you, the value of the transaction is the removal of catastrophic liability from your personal balance sheet. Capping your potential losses with known fixed premiums creates the stability required for long-term wealth accumulation. Real financial security requires identifying the risks that could bankrupt you and transferring them to a larger pool, allowing you to focus your resources on building for the future.